We've got Stephen on the line from Vancouver. Go ahead, Stephen.
Thank you for taking my question,
Pleasure.
gentlemen. My question it is on Kiera, and I'm looking if it is a good choice for my RRSP because of its high yield. And hopefully, I would like to ask your opinion about its downside protection. And that, may I ask a question, is that it has a negative EPS. If you can kindly explain that, if possible. Thank you very much, sir.
Okay, I don't know if we can get that deeply into the numbers, but go ahead, please, David.
Yeah, again, we're going back to energy infrastructure here, and while it has bounced off the lows, it still continues to be sort of a relative underperformer. It's got a 6% yield. They've been able to grow their dividend over time about 10%. So that is attractive. I just really would like you to go more toward market strength, and I think you're probably going to get, if what you're looking for is dividend growth, I would lean you more toward a financial in the dividend growth space, or like an apartment REIT, which is going to give you probably stronger dividend growth or distribution growth. If you want to be in the space, Enbridge looks pretty good, and I'd recommend that over Kiera right now.
Okay, thanks for that question, Stephen. Carla in Edmonton, go ahead, please.
Oh, hi, guys. Thanks for taking my call.
Pleasure.
My question is in regards to CN Rail and whether you would recommend holding that in an RESP account. We have a couple banks, utilities, and a few ETFs, and I'm looking to add another stock. We'd be in it long term, and I am not an active trader, so I would like to have something that, just a solid company that I can put in there and leave. Look forward to hearing your thoughts. Thanks.
Buy and hold CN Rail.
Okay, look, CN Rail is a great company. It's been really well managed over time. They've done a great job of growing their dividend over time. It's averaged about a 12% growth rate, which is really attractive. It's a lower dividend stock, but I would prefer a lower dividend stock with a higher growth rate than a high dividend stock with a low growth rate. Okay, because if we are into reflation, you need to have companies with pricing power that benefit from a strengthening economy, and CN Rail fits that bill. Companies that are more in sectors that are more defensive, that don't really benefit from an improvement in the cycle, don't really have pricing power, I think is tough. The rails have had great pricing power over time, and there's just they all have their strengths depending on their route maps. But CN Rail has a really defendable position, so I have no problem you owning that in the RESP.
We have Bill on the line from Ontario. Go ahead, Bill, please.
Yes, could I have David's thoughts on OLED, please? OLED,
sure.
Or if he doesn't like that, another stock in that industry. Thank you.
And just remind us what OLED is, please, Dave.
So they do organic light emitting diode devices. Okay, so it's for consumer electronics. They get put into smartphones,
sure.
Laptops, TVs, lighting products. So just out of interest, I went through about 1,200 charts last night, which I do regularly, to cull through and see what's kind of showing up. Tech has been a group clearly that we've liked for a long time, and there's a bunch of spaces within there. These consumer devices are going to continue to garner a bigger piece of our wallet, and OLED, or Universal Display, is a leader in their space. So it's about a $5 billion company, put in a low in June, retested the low in December, held much better than the group, and is making a really nice turn. So I would be comfortable owning the stock here. It's a more aggressive company. But of the 1,200 companies I went through last night, I'm going to say there were 50 to 60 that I thought looked timely, and OLED is one of them.
Okay, we have a tweet from Oliver. He's curious about Skyworks. What are your thoughts on Skyworks, or could you recommend another 5G player?
Okay, so the semis and the electronic component companies had a really hard fourth quarter. Right? Very, very hard fourth quarter. A lot of it because of, concern around slowdown at Apple. The thing you have to remember is that analysts and portfolio managers look about 12 to 14 months ahead. And so through the course of the second half of last year, people looked at the fact that there could be some slowdown. Now, what's happening is that the analysts are now looking beyond that slowdown to what could be reacceleration in the second half. So Skyworks provides a zillion small components to the electronics manufacturers. They reported a number that was weak, and the stock took off. That tells you the market is looking beyond the current slowdown. And in a bull market, those short-term slowdowns, you can't stay negative while the numbers are weakening. I mentioned 95, where all the economic data weakened through the course of the year. The market went up 38% looking at what was coming next. So I think that Skyworks is a great way to play the components companies because they really have a wide net. You could look at semiconductors like a microchip, which also makes analog semiconductors. It goes into all kinds of things. These things have had their correction. They're on the other side.
Sorry, was that a company or just broadly the semiconductor space?
So semiconductor space, but I mentioned microchip.
What's the symbol on that
MCHP.
one? MCHP.
Okay, and they make analog controllers that go into cars. They go into all kinds of things. Look, we're in the Internet of Things. You want to own things that benefit from that structural long-term theme. Skyworks is one of those companies.
Okay, and there's Microchip Tech. Okay. Richard in Green Bay, Ontario. Go ahead, please.
For taking my call.
Pleasure.
Hi, my question's on Cameco. I've held that for many, many years before Fukushima, so I've seen it go down. I bought some more throughout the years, and now I'm pretty much break even, and I'm thinking of getting out. What do you think about that stock? 12 to 24 months out. Thank you, and I'll listen to your commentary.
Okay, so there's secular growth and there are cyclicals. And we know that commodities have underperformed stocks for many, many years. They had relative highs in 2008, like emerging markets did, and have relatively underperformed until really very recently. And I think that we're starting to see a turn. So nobody has heard me make a recommendation on a resource stock in many years. But I do think that we are seeing good risk reward in some of these areas, and uranium's sort of interesting. So, so this is where I'd be buying Cameco.
Okay.
And in fact, I bought URA, which is the ETF for uranium and uranium producing companies, just this past week. And I suggested that we put on a position in Cameco. So I'm sure you're frustrated for having held it all through this relative underperformance. I would say this is not the time to be a seller. This would be the time to be a buyer.
Okay, so you would stick with Cameco for now. Richard, thanks very much indeed for that question. We're going to be back. Wow, we're flying through the show today. Top picks already. Okay, we're watching Market Call on BNN Bloomberg.